All right, good afternoon, everyone. Welcome to the Daniello Institute for Veterans and Military's Families VetNet webinars. This is our first VetNet webinar for 2023, and we're happy to kick off this session with our special guest speaker, Doug Rotatori. So if you're not familiar with the IVMF, we are a national institute that really focuses on serving the military-connected community, veterans, military spouses, and transitioning service members. We have a whole range of programs, research, entrepreneurship, and career prep that helps that community as well. So today's session will be focused more on the entrepreneurship side, leading your business through an economic downturn. And what I'm going to do now is turn it over to Doug for an introduction of himself.
Thank you. Appreciate it. Very happy to be here with you this afternoon. My name is Doug Rotatori. Let me start with giving you a little bit of background on myself. Out of college, I worked for Accenture designing software systems for a variety of businesses. Then I went back and got my MBA at Northwestern. And then the last 35 years, I've been spent largely working directly with management teams of a wide variety of companies and a wide variety of manufacturing and service industries, helping them build their businesses and create value for employees and owners in all sorts of business cycles. The playbook that I'm going to discuss today is really the result of my collective experiences over that 35 years. And almost all of it comes from working with those managers and those management teams and myself together and making a lot of mistakes, trying to figure out what changes we need to make in downturns or in recessions. And so every one of those was a learning experience. And the playbook that I'm going to lay out for you today is really sort of an amalgamation of my thoughts after all that, after that career. First slide, please. I'm sorry, let's go to the next one then. Oh, that was me. That was my intro. All right, one more. All right, the agenda today. So just quickly, what I'm going to talk about today is really, helping understand what is a recession, how often they happen, and versus a general business downturn. The second one is what are the biggest mistakes that I saw managers make and myself make as we move through a recession or into a recession or a downturn. The third thing is going to be talking about understanding and maximizing your liquidity or your cash position in your business. Then next, developing a plan of how to think about changes you can make while you enter a recession. And then lastly, just a summary. Next slide, please. So when are you in a recession? Every business and industry is somewhat unique. And so slowdowns and recessions don't impact everybody the same. It could be the industry, it could be the geography. And also understanding when you're in a business slowdown versus a recession are not easy. For right now, we're not in a recession right now in our current environment, but we clearly are in a business slowdown and a major business slowdown, especially in certain sectors like the tech sector. But major recessions, those are typically global recessions that impact everybody. And when they hit, they usually hit fast and they hit deep. So maybe let's just click through each of the four recessions that I've experienced in my career back 1990, 91. That was the S&L crisis, marked by a period of extremely high interest rates, and then the Iraq invasion of Kuwait. Then in 2000, if you click, I think some bullets will come up, maybe. Let's just see. Yep, there you go. 2000 was obviously the dot-com crash, and then the 9/11 attacks. 2008, 2009. Go ahead and click that one. That was the subprime mortgage crisis and entering the Great Recession. And then lastly, as we all know, COVID. We're not predicting one of these now. Very few people are predicting one now, but clearly we're on the eve of a major business slowdown, in my opinion. The playbook that I'm going to discuss with you today, it applies to both major recessions as well as business slowdowns. So these are just concepts and a framework to help you think about managing your business, whether you're in a good time or a downturn or a global recession. Next slide, please. So the two biggest mistakes I've seen managers make: first, they don't have a plan. They wait for something to hit. Typically, recessions or slowdowns come after a period of a very vibrant growth economy. They've been consumed in growing their business and haven't taken the time to develop the framework of a plan about how to manage a business and what changes they need to make. And the second one is they don't really understand their liquidity or their cash position. If you remember one thing from this whole presentation, it's that the most critical thing in a downturn or recession is understanding and managing your liquidity or your cash. Next slide, please. So let's talk about understanding your liquidity first. This is, when I mean your liquidity, this is simply making absolutely sure that your business has more than enough cash to survive a recession or a downturn. This sounds like a pretty simple concept, but it's not. Why isn't it a simple concept? Because two things happen in a recession. The cash or liquidity that you thought you had may not be actually what you have. And I'll explain what that means in a second. And the second thing, behaviors change in a recession. We've seen it, certainly saw it in COVID. Your customers' behaviors change, your suppliers' behavior change, your lenders, your bank lenders, their behavior changes, and even your employees' behavior changes. So all of those have a trickle-down impact on your liquidity, or a potential impact on your liquidity. I'll give you one example of a company that we owned. The company made metal and plastic accessories and components for the concrete construction industry. And so we knew that was a cyclical business. And so when we bought the company, we managed it. We had a whole separate line of credit that we didn't use to save. That was our cash for when the recession hit. And it was based upon, it was what was called an asset-based loan. And it was based upon our receivables, our inventory, and our property, plant and equipment. So when, after 9/11, when the commercial construction and residential construction industry hit a significant decline, the bank actually got nervous and sort of unilaterally went ahead and changed the advance rates on all those assets we had. So all that liquidity that we thought we had got cut in half, and it put our company in an extremely difficult position. So we thought we had a plan and we had it figured out, and the lenders reacted differently. Their behavior changed, and these were lenders that were good partners with our firm. Their behavior changed because they got scared, and that put us in a very difficult financial position. Let's go to the next slide, please, and talk about how the behaviors change of your other constituencies and how that might impact your business. So let's talk about your customers. Your customers stop or slow their buying, and they typically take a lot longer to pay what they owe. They're nervous about their own cash, so they're not going to pay you as quickly as they might normally would. Same thing, your suppliers. They're getting nervous, so they may extend you fewer terms. Depending on your financial position, they may demand cash up front from you in order to keep supplying you product. So, and lastly, as I talked about, the banks may get nervous, like in that example I said. So there's this ripple down effect of behavior change from all the different components of your supply chain, both from suppliers all the way to customers, that will impact your liquidity or the cash that you have. Next slide, please. So how do we start thinking about your liquidity and managing that? So the key to that is really understanding where your cash is tied up. And that lies virtually in every line item on your balance sheet. So think about it, your receivables, as we just touched on a bit ago, your receivables, that's what generates your cash when you sell product. In a recession, two things may happen. First, your receivables are going to shrink because your customers aren't going to buy as much. And then second, your receivables days gets extended because your customers aren't going to likely pay you as quickly for the product that they are continuing to buy. So that is going to generate much slower cash turn for you. Your inventory, same thing. Inventory turns. One of the mistakes we see a lot of managers make is they see the recession or the downturn, but they don't change their inventory building patterns. So inventory doesn't turn as fast because your customers aren't buying as much product, but yet you're slowly building excess inventory. So you're taking your cash, instead of preserving it, you're tying it up in inventory that may not generate cash for 30, 60, 90, 120 days. Your property, plant, and equipment, a lot of cash tied up in that. And most of that is illiquid because you've spent it on forklifts, you spent it on computer hardware, you spent it on things that you can't turn into cash, readily turn into cash. Lastly, your payables, same thing. Your AP, your vendors are putting pressure on you to continue to pay on time. So while your receivables are getting extended out, generating less cash, you're still paying your vendors within 20 to 30 days to maximize the various discounts. Next slide, please. So let's talk about some things you can do to manage your balance sheet and preserve liquidity. First, aggressively manage your working capital. Focus right away on building inventory, adjust your production schedule so that you're matching what are your expected declines in your top line for your key products. Don't build unnecessary inventory. Delay pay your suppliers. I mean, typically you may pay in 20, 25 days. That cash is precious. So maybe you pay in 40, 45 days. And then stay on top of your customers to collect your receivables. Don't let them do to you what you're trying to do to your vendors. You can do this artfully. You can call them. You can say, "Hey, how you doing in this downturn? What problems are you seeing? How can I help you solve some of your problems?" And then say, "Oh, by the way, your receivables, I really need you to put some pressure on your controller to pay my receivables. I need that cash." Next step, conserve your cash. So avoid spending on non-critical capital items. So things like computer hardware and furniture, things that small items every day you might, in a good business environment, that you might approve. Really clamp down the spending on items like that, and also eliminate or reduce expenditures on expenses like trade shows, travel, entertainment with customers. We have this wonderful thing called Zoom, which we're taking advantage today. And it's truly a godsend because it still allows you to connect one-on-one with your customers in a time when maybe you don't want to spend the money to hop on a plane or get in a car and drive 5 hours to visit them. So you can do things that are very cost effective, but that conserve your cash. Lastly is look at your fixed assets, your property, plant, and equipment. As I said, most of those are liquid, but I'll give you an example where one saved one of our companies. So that company that I just talked to you about that made the components for concrete construction, after the banks reduced our line of credit, we were in a difficult position. So we looked at all our assets. We had a handful of distribution centers around the region where we owned the property and we owned the building. So we bundled them together and entered into a sale leaseback transaction with a bank that allowed us to generate a large sum of cash up front and avoid and then paying lease expense over a much longer period of time when the economy got better and our business got better and we had the cash to pay those lease expenses. Next slide, please. So let's move to addressing the second mistake that I talked about, and that's not having a plan. So I'm not talking about a step-by-step plan that you have in a notebook filed away somewhere. I don't think that's that's practical. What I'm talking about is having an understanding of your business, where you know where you can make changes or implement actions to improve your liquidity and your business prospects without negatively impacting your business in the long term. Again, this is about survival. You have to react quickly. So having thought through those different items will allow you to reduce the learning curve, so that when a recession or a downturn hits and you're faced with some of these things, you've already thought through all the key steps that you might be able to take to preserve your liquidity and survive. I'll give you an example of a company that did this incredibly well. We owned a company that made parts for the aerospace aftermarket. So as planes flew miles, they would have to go in for checks, and they would replace certain parts at certain intervals of airline miles. So obviously, after 9/11 happened, the airline industry was basically shut down for a sustained period of time. Nobody had any idea how that might impact the economy, or specifically a business that was tied to the aerospace aftermarket. Within 48 hours of 9/11 happening, the management team of that company sent us a plan that was based on a whole different set of scenarios of a 10%, 20%, 30%, up to a 50% decline in airline miles, and then all the resulting production cuts and cost actions that they could take in each one of those scenarios, whether that downturn lasted 3 months, 6 months, 9 months, a year. And so as we worked through the impact of 9/11, they were able to start putting those actions into place right away, because they had thought through them and they had presented them to us, and we were on board with the types of changes they needed to make to their business. The irony of that situation was one of the things that came out of that was all the cockpit doors of those planes were retrofitted with locks, so that the same terrorist action couldn't happen again through that. And this company sold all of those retrofitted doors, so it actually ended up in the long run being a great product for the company. But it took a long time to get to that point. Next slide, please. So in developing the framework of a plan, I think it's important to ask yourself some critical. Sorry, just go back one slide. There you go. It's important to ask yourself some critical questions. So how will my customers behave? Typically, if you have 1,000 customers, most of the time you find that they'll mostly react the same. But if you have 1 or 2 or 3 major customers, really thinking through what their personalities are like, what their cultures are like, how will they behave in the face of recession, helps you then figure out how you may react. An interesting one is how do you think your competitors will behave? Competitors may, for example, they may lower their prices to try to stimulate demand, not understanding what's going to happen. So that customers that would typically buy for you that are price sensitive now may go and buy from your competitor. So understanding that you have a competitor that competes on price can be very helpful in helping you determine what actions you could take. Conversely, a lot of times competitors may retrench. They may lay off a bunch of people, be very aggressive to preserve their cash, and then that creates opportunity for you. So really thinking through how your competitors may behave in the face of a recession can also help you start tweaking the shape of your plan on the actions that you might take. Next slide, please. So let's talk about the structure of a plan and how you build one. I like to group it into these 6 buckets. So first one, control costs and spending. I think that's pretty straightforward. That again focuses on maximizing your cash. The second one, conducting an employee assessment. What this really involves is digging into your payroll, understanding all the different elements of your payroll and where you can lower your payroll costs and where you can't lower your payroll costs because the risks are too great to your business. Third one, implementing operational efficiencies. This is, change gets hard when you're busy. All your employees are tied up. Trying to get them to change their processes are difficult because they don't have time to do that. But when you enter a downturn, typically employees have a little more free time. They're a little more open to change, and you can start implementing some efficiency changes in your processes or your technology that are much easier in a downturn, and that will create a lot of operating leverage for you as you come out of a recession. The fourth is refocus on being excellent at your core product or service. Get back to being great at what you do best. It sounds like a simple thing, but it gets lost a lot of times when companies are in growth mode. They're expanding their customers, they're expanding their products and services, and sometimes what you do great gets diluted. The next one, play offense where you can. This is one of my favorite ones because it's probably the one that's the least obvious to managers when they're in the middle of a downturn, because most of the time you're thinking about survival and retrenching. But you can create a lot of value if you've managed your liquidity well and you have the cash cushion. There's actions you can take by playing offense that will really accelerate your growth and profitability and value creation when we come out of a recession. And lastly, maybe one of the most simple ones, but maybe one of the most difficult, is having an effective communication strategy with all your key constituencies. And we'll talk about that in a second. Next slide, please. So the first one, let's dig into each of these buckets for a second. Control costs and spending. So how I like to think about this is segmenting our costs into controllable versus non-controllable expenses. So let's describe what those are. Controllable, that's like your marketing dollars, that's your hourly payroll, that's bonuses. These are things that you can say, I'm going to spend this or I'm not going to spend this. So you control those dollars. And then you have non-controllables. Those are things like your rent or your lease payments, employee health care, insurance, property taxes, things that you got to pay regardless of the business environment you're in. So once you get down into understanding what are those costs that you control, this is what we call our discretionary spend. So what we like to do is identify all of your non-payroll spend. So let's segment the payroll side of your people expenses, and let's identify every category of your non-payroll spend. When times are good, what typically happens is excesses get built into your non-payroll spend. These are things like customer entertainment, trade shows, things like freight subsidies or even free freight. Times are good, you're generating a lot of profit, you're much more likely to spend dollars, keeping your customers happy and growing your business. It's critical, though, when you enter a downturn, that you eliminate those and that you understand where those things are. Second thing, renegotiate leases and rents. As I said, these are typically non-controllable, but the landlords, they want to keep you as a customer. They don't want you to break your lease. They don't want to have to sue you for your lease payments. And so if it's a challenging environment, obviously like we did in COVID or the Great Recession, your landlords are going to work with you. You go and say, listen, I need to renegotiate my rent down. I need to extend it out. Typically, they will work with you and they want to keep you as a customer. Lastly, evaluate your staffing level. So now let's get to the payroll portion of your discretionary spend. This typically can make up the largest dollar spend for many companies, your people costs. So I like to segment this into hard and soft changes. Before I jump to the next slide, talk about hard and soft, I want to tell another quick story about a company we own that had this phrase, pick up the nickels. This was a CEO, and he was laser focused on making sure we did not waste money on unnecessary expenses. This is regardless whether we were in a good time or a downturn. And he had this phrase, pick up the nickels, and he would go to every employee in the company and he encouraged them. He established a culture of efficiency and cost control. So anytime an employee saw an area of waste or where we were spending money that we didn't need to spend, they could bring that idea to the CEO, and he would discuss it with them. And if it was a valid idea, he would give them a large wooden nickel. It was completely symbolic, but it really helped establish that culture of we can't be wasteful. We need to manage our money, and that's going to inure to the benefit of all the employees. Next slide, please. So let's talk a little bit about making changes to payroll via hard or soft actions. Making changes to payroll is one of the most complicated things in a business. So you need to be careful, and you need to be creative to try to do it in the manner that has the least negative impact on your business prospects. So we start with what we do is conducting an employee assessment. This actually is something that you should do annually as a best practice. Every year you should review all your employees, give them feedback as part of maybe a compensation evaluation, give them critical feedback on how they can improve, areas of opportunity for them to grow in their business. So it's critical. If you've done that annually as part of a best practice, this next step is a much easier step. So the first hard cost actions that we can take with our payroll during a downturn. First thing, right size your hourly payroll to the new or lower volumes, right? As soon as COVID happened, we weren't producing anything. The phone didn't ring for weeks. Nobody wanted to buy anything. Nobody knew it was going to happen. So, if you have hourly payroll that is volume dependent, you're running multiple shifts or whatever, that's something that you can manage and reduce right away. The second thing, element of this is what I call eliminating the OT or overtime creep. Typically, when companies are busy and in good growth mode, instead of it's difficult to hire new employees because the employment rate's very low. So you ask your existing employees, hey, we're really busy. Can you work a half a shift longer? Can you work a couple more hours? Can you work a day on the weekend? And most employees love that because they get paid time and a half or double time. But that's super expensive. So the marginal profit on that extra dollar of product they're working on is much lower because you're paying your employees 150 or 200% of the normal hourly cost. Employees love overtime. In my experience, I've never met employees that didn't love getting paid overtime. But when volumes decrease, they also don't want to give their overtime up. You got to know exactly where you're spending your overtime and eliminate it as quickly as possible. The second part of a hard change you can make is use this as an opportunity to prune your bottom performers. When times are good and when you're busy, you may tolerate subpar performers, but you're in a scenario now where you've got to eliminate people. If you already know who are your bottom 20% performers, and you've done that through your annual employee assessment, this is the time to eliminate those employees. So as an alternative to outrate or some of these hard actions, we have soft actions you could take. We just came through this period of COVID where I know for almost every business, it's been extremely difficult to replace the employees that you lost. So as opposed to outright cutting heads, let's examine some soft changes that you can make where you preserve your employees, but yet you can figure out ways to be creative to reduce your payroll expense. So whether that might be a temporary furlough where you say, we're furloughing you for 2 weeks, for a month until we understand this better, but I'm guaranteeing you a job when you come back, or a partially compensated leave where you pay people a portion, but you essentially give them a vacation and you're paying them a portion of their salary, or even partial work weeks or work from home with reduced hours. Again, we have this magnificent thing, Zoom, where a lot of your employees can work from home. Maybe you say work a half day, work from Zoom, and I'm going to reduce your compensation, but I'm still going to pay you something. So there's a lot of creative ways that you can manage your payroll, maybe save 10 to 20% of your payroll expense through a variety of these cost actions. Next slide, please. The third one, implementing operational efficiencies. These are changes you make that may not result in immediate cash savings, but will make you a better, more profitable business in the long run. So let's talk about a couple of areas that might be ripe for identifying operational efficiencies. First one is evaluate the processes that you have your employees doing in your business. So if you just map out, watch your employees and you map out the steps that they take during a day or a normal work day, you can identify wasted time while employees are waiting for the next step. This could be in a production process where they're waiting for product to come down a production line. It could be in processing information in an office. So where they are responsible for step A and B, but in order to do step E, they need another employee to do some interim steps. So they're sitting there waiting to do work while other employees feed them information. That's inefficient. You're paying them and they're not producing. So identifying those and seeing how you can change those processes to eliminate that inefficient downtime. Second thing, similar concept, unnecessary movements by people. You've got people on a shop floor. They may be part of a production line. They take a product and maybe it's got to go to a separate step as part of that production process. So they pick it up, they carry it somewhere, they put it on a forklift, they move it somewhere, and they're maybe going across the floor, then they're coming back. That's just waste. So identifying that wasted movement by people and rejiggering your shop floor layout or your floor layout to eliminate that excess movement can also free up dollars and make your employees more efficient. Same concept with transportation, whether it's a service vehicle or a truck that's delivering a product. There's a lot of great technology out there, sensor technology, where you can map where all your equipment is going and when it's down, how long they're taking lunches. There's a lot of ways to help identify unnecessary movement or inefficient movement by your transportation vehicles. The next area that's ripe for operational efficiency is identifying unprofitable customers. This is a really interesting one. Every time we brought this up with managers, the reaction is, I don't have any unprofitable customers. I make money on all my customers. But it's an interesting one. What a lot of times they'll say, okay, here's my customer. Here's the gross margin I make on the product. But it doesn't really capture what we call a lot of the soft costs. Are your salespeople having to spend a lot of time with that customer? Your customer service people, are they spending a lot of time? You may not be billing for that, but it's sucking up a lot of soft dollars to keep that customer happy. Does that customer require a lot of tweaks in the product? So you have your R&D guys or your engineers spending a lot of time with them. If you're not charging the customer for all that time and effort, that's what creates an unprofitable customer. Those are tough costs that are very difficult to allocate back to a product or a customer. So a lot of times you think you're making money, but by the time it drops down to the bottom line, you may be breaking even or maybe even losing money on certain customers. Same concept with identifying unprofitable products or services. When times are good, you tend to expand a little bit, sell their stuff to your customers, and you think you're making money on them. The customers like it. It's a nice to have. We'll talk about nice to haves in a second, but you may not be really making money. So identifying, knowing those where, and maybe you decide, hey, I got to continue to do this because my customer loves it. And when we come out of the recession, this is going to be a big growth area for me. If that's the case, then you keep it in. But if it's not, those are areas that are ripe for operational efficiency improvements. Next slide, please. Refocus on being excellent at your core. This is sort of a touchy-feely concept. Many think that you're always being excellent at your main focus, whether it's a product or a service. But as I said earlier, a byproduct of growth is potentially straying a little bit or diluting your core product or service, because that's typically what you get growth by selling more to a lot of your existing customers. And it's natural to want to make your customers happy. So you tend to do more for things for them, even if it's not critical to your business or it's not generating profit for you. So this is what we come to nice to haves, and it's very common. A customer says, would it be nice? It would be nice if you could also do this or sell me that into this main product. And the customer's buying a lot. You're inclined to say no, I'm not. You're not inclined to say no, I'm not going to do that. So a lot of times you build in these nice to haves that your customer wants, but they don't generate you any money. In fact, you may lose money on them. So this is the kind of environment where you really need to understand those, identify them, and talk to your customer and tell them, hey, you can't do this anymore. You're not making any money, or they got to pay you for it. Next slide, please. As I said up front, this is one of my favorites. Play offense where you can. If you've done a good job at managing your liquidity, and again, that is still your number one focus, you need to manage your liquidity and your cash position. You always got to make sure you have excess cash to survive. But if you've done a good job of that, let's talk about some changes that you can make to maybe take share from your competitors and accelerate your growth coming out of a recession. So while your competitors may be retrenching, maybe you can invest in key people. So oftentimes we'll say, why can't you get into this customer? Well, my competitor has the best sales guy. He owns those 3 or 4 customers in that market. I just can't get to. Well, maybe this is a time, if your competitor is retrenching, maybe you can go recruit that salesperson away, offer them a signing bonus to get them on your team, knowing that you've got the cash to play offense. And when you come out of recession, that salesperson is going to generate excess profit and revenue for you. Second, maybe you can invest in new equipment, spend some money on R&D, get close to your customers, understand what their business is doing in the long term, where do they see growth opportunities, and say, hey, I'll work with you and build some product technology or service around helping you get to that goal. Another one that was one of our favorites was buying one of your competitors. A lot of times you have competitors, they don't want to go through another recession. It's a privately owned business and they're tired. And so that sometimes is the best time to buy one of your competitors and expand your business via that manner. And the last is just buying or building complementary products or services. Same thing, identify a competitor that sells something that you haven't developed. He does a great job of it. You can add that product in. He's also probably going to bring you some new customers to sell your main product to. So this is another great time. If you have the liquidity and the cash, you have strong investors backing you to go out and be aggressive, building your business through buying competitors. Lastly, on this one, this is a great, one more. Prioritize your customers based on the ones with the best long-term prospects. It's a great time in a downturn to invest in truly knowing and truly getting to know your best customers. Typically, in a lot of businesses, you have the 80-20 rule where 80% of your profit comes from your top 20% of your customers. Make sure you know who those are. Make sure you have a great relationship. Stay close to them. Turn challenge into opportunity by working with your best customers in a downturn. Last slide. Communicate. Again, this was the one mentioned up front. Really difficult for people to figure out an effective communication strategy, but it's critical in this kind of environment. It gets harder to communicate in difficult times because most of the time you're delivering bad news, whether it's to employees or to customers or to vendors. But in my experience, people do understand. They read the papers, they're seeing the news, they know we're in a difficult time, they see other companies doing layoffs. So if you communicate with them, if you're compassionate, if you're realistic, most of the time, while the message is a hard message, people do understand why you're doing it. I also think it's critical to communicate effectively. You can learn a lot by listening to your customers and suppliers. Getting critical intelligence up and down your supply chain, that just helps you react more effectively. If you're talking to your vendors, chances are that vendor is also supplying your competitors. So by talking and getting close, you can understand more critically what your competitors are doing and what their customers are doing. And so really being aggressive and making sure you don't become insular in a recession is critical. Communicate, helps minimize confusion, misunderstanding, rumors. Take control of the narrative. It's one of the great sayings, one of my CEOs, he hated when rumors got out there. He loved being out in front of everything. And that allowed him to turn uncertainty into advantage. Last slide, please. So again, thank you for your time. Enjoyed speaking with you. Just to review, understand your liquidity. The single most important thing about what I said today, make sure you think about your cash every day. You don't know when the recession hits, be prepared, and develop a plan. Thank you. Happy to answer any questions.
Thank you so much, Doug. And for everyone that's listening live today or that may be listening to the recording at a later date, we will share this information along with Doug's contact information that you see here for if you have any follow-up questions. Doug, we did have a question come in advance from somebody that registered. I think it probably goes along the lines of when you were talking about identifying unprofitable customers. The question is, what are some ways that businesses can manage their risks when it comes to the types of clients they bring in as customers?
Yes, there's no simple answer to that, because I think it depends on the risk you're trying to manage. Is it a credit risk? So the person wants to buy a lot, but you're not sure they're going to pay on time. So understanding how you might deal with that. Maybe you say, okay, I know you want to buy, $500,000 worth of product, but you're a new customer, you haven't been in business that long. So how about if I supply you 50,000 and we'll do more frequent intervals? So I think it depends on the nature of the risk that would dictate how you might deal with that customer. Obviously, if somebody's coming to you at a difficult time, a recession, whatever, and wants you to sell them something, I mean, that's a valuable customer. So you're going to try to figure out how to do it. But I think I would need to know a little bit more to give the proper advice on that.
Yeah, definitely. Another question that we have is, when do you think business owners should start taking the steps that you've laid out here or developing a plan? And did you find over your career or over these, 4 major recessions that you experienced, that those plans changed it or they evolved, during each recession?
Yes. Well, first of all, there's no reason somebody shouldn't think about these things today, even though we're not in a recession today. We're arguably in a downturn, although some businesses are still in growth mode. But there's no reason you shouldn't be developing these plans and thinking about these issues that I talked about today. As I said up front, every recession is different. So you have a plan, but that plan is going to change. Businesses aren't static. What condition your business in, what competitive position, what your balance sheet looked like in one recession could be totally different in the next downturn or the next recession. So this is not a one and done where you think about it once and you stick it on a shelf. This is like a constantly evolving a plan that you got to think about. Best practices in our companies, when we did our annual planning, whether we were in growth mode or whether we were in a downturn, we always talked about both. You're always thinking about, okay, if it turns, what am I going to do to accelerate my growth coming out? Or if we go into a downturn, what are the actions that we should be taking and that we're thinking about if we enter into a downturn? So it's a constant thought process, and it really should be ingrained in your sort of annual thinking.
Yeah, that makes sense. And, when you're in one of these economic downturns, how long have you seen it take for businesses to bounce back? I know that probably depends on industry and the type of economic downturn that you're in, but do you have a general response for that?
I often, again, this is a general comment because every Every downturn or recession is different, but I do find that you have, what green shoots, you tend to get those quicker. People don't like being in a depressed state. So I think people crave growth. So even when you're downturn, they're thinking about how you can revolve. Government, we've seen government actions in terms of liquidity. We saw COVID where almost overnight they infused cash into the economy, which preserved growth. And so typically you go into it much quicker and you come out of it much quicker than you might think.
That's great. Thank you. And the final question that I have, if there's any other questions from the chat, happy to take them. But is there anything else that you would like to leave the audience with? I know we went over a lot today, and people will kind of take this and think about what you've presented. But is there, one high point that you'd like to leave the audience with?
I think it's the same one I finished with. Understand your liquidity. It is the single most important thing. If you run out of cash, that is the single worst thing that could happen to you, because then you're in desperate mode. So if you had a valuable business and you run out of cash and you need to go raise equity or sell your business, people are going to see that and you're not going to get paid the value for your business. So understand and manage your liquidity, the single most important thing to take away from this presentation.
Great, thank you. And we did have a question that came in, if we can tag this on to the end. So you might see it in the chat here, but if you're going to your financial institution for some possible financing solutions, what are the most popular options a bank will like to offer? And what does that business owner need to be prepared for?
Yeah, that's a great question. First of all, don't wait until you need the cash to go talk to the bank. If the bank's first thing to do is going to tell me about your business, show me your financial statements. They're going to see that you're coming to them at a time of need, and they're going to be naturally reluctant to provide you money when they know your business is maybe potentially struggling or entering into a difficult period. So always be managing those relationships with your lenders and having that liquidity. Think of it as like an insurance policy. You may not need it today because business is good and you're generating cash. So maybe you're paying a small amount of money to your bank to have a line of credit. That's probably the first place you look. It's a line of credit that's based upon your receivables and your inventory. You may not even borrow on it, but it's there. And they're going to be much more likely to give you that liquidity or that loan when times are good and they're looking to grow their business and put out money. So that's probably the easiest one to get to, is when a bank will lend you money against your assets. And the second one, if you have a good, strong history of generating cash flow stability, then maybe you can get a cash flow loan. But again, the most important thing is go to the banks when you don't need the money, not when you need the money, because that's when they're going to, it's going to be challenging to get them to lend you the money.
Right. Thank you. Great advice there. So thank you everyone for joining us today. We're going to wrap up here shortly, but if you have any questions for Doug or based on this presentation afterwards, you can always reach out to us. We will be sending the recording to everyone who registered for today's session. So Doug, just want to thank you so much for all the information that you presented today, and thank you for sharing your expertise with our community. And thank you all for joining us today. Happy to have you all at our next VetNet in February, but until then, have a good day.
Great. Thank you, everyone.